Hey there, welcome back to Finance and Fortune, the channel where we help you make smarter financial decisions and grow your wealth. If you're in your 30s, you've likely already taken some big steps, whether it's advancing in your career, starting a family, or even buying your first home. But with great responsibility comes, you guessed it, great potential for financial missteps. Your 30s are a crucial decade. The decisions you make now can set the stage for a life of financial freedom or burden you with stress and regret. And that's exactly what we're going to talk about today, the biggest financial mistakes to avoid in your 30s. But before we dive in, if you're new to the channel, or if you've been watching for a while but haven't yet subscribed, now's the perfect time to hit that subscribe button. We're constantly putting out videos to help you stay ahead of the game when it comes to personal finance. Don't miss out. All right, let's get into it. Here are 10 financial mistakes you definitely want to steer clear of in your 30s. 1. Not having a solid emergency fund. Let's kick things off with something that often gets pushed to the back burner, your emergency fund. Life is unpredictable. You might feel financially stable today, but what happens if you lose your job unexpectedly? Or if a sudden medical emergency strikes? Without an emergency fund, you'll likely have to rely on credit cards or loans to cover these costs, which can send you spiraling into debt. The goal is to have at least 3 to 6 months of living expenses set aside in a liquid, easily accessible account. For example, if your monthly expenses are $3,000, you should aim to have anywhere from $9,000 to $18,000 in an emergency fund. This financial buffer allows you to cover unexpected expenses without derailing your entire financial plan. Pro tip: if saving 6 months' worth seems daunting, start with 1 month of expenses and build up from there. Every little bit helps. 2. Ignoring retirement savings. Retirement may feel light years away, but your 30s are the prime time to make sure you're setting yourself up for a comfortable future. One of the biggest mistakes people make is assuming they can start saving later. But here's the thing: the earlier you start, the more time your money has to compound. Let's break this down with an example. If you invest $500 a month starting at age 30 and earn an average return of 7%, you can have around $600,000 by the time you're 65. But if you wait until you're 40 to start saving the same amount, you'll only have about $300,000. See the difference? You'd have to save twice as much in your 40s to catch up. Take advantage of any employer match for your 400 and own it. That's essentially free money. And if you don't have access to a 400 and own it, open an IRA or a Roth IRA and contribute regularly. 3. Overspending on housing. We all want that dream home, but don't let the excitement of homeownership cause you to overspend on housing. Here's the deal: your housing expenses, whether it's rent or a mortgage, shouldn't take up more than 30% of your income. Any more than that, and you risk becoming house poor, where a big chunk of your income is tied up in your home, leaving little room for savings, investments, or even fun. When you buy a home, it's easy to focus on the mortgage payment and forget about other costs like property taxes, maintenance, homeowners insurance, and utilities. These can quickly add up and stretch your budget. Renting can be a smart move too, especially if you're not yet ready for all the financial responsibilities of homeownership. Don't feel pressured to buy just because others are doing it. Pro tip: get pre-approved for a mortgage before house hunting to set realistic expectations for what you can afford. 4. Accumulating debt for lifestyle choices. As your income grows in your 30s, it can be tempting to upgrade your lifestyle. New car, fancy vacations, or designer clothes. While it's okay to enjoy the fruits of your labor, don't fall into the trap of accumulating debt to fund these luxuries. Relying on credit cards or personal loans to maintain a lifestyle you can't truly afford can quickly snowball into unmanageable debt. For example, imagine you spend $10,000 on a vacation using a credit card with a 20% interest rate and only make minimum payments. By the time you pay off that trip, you could end up paying double the original cost. Definitely not worth it. Instead, focus on living below your means. Automate savings or debt repayment before splurging on lifestyle upgrades. Financial freedom is far more rewarding than keeping up with appearances. 5. Not investing in yourself. While overspending is dangerous, not spending on yourself can be equally harmful. Your 30s are a pivotal decade for personal and professional growth. This is the time to invest in new skills, certifications, or even additional degrees that can increase your earning potential. Think about it. If you spend $2,000 on a certification course that qualifies you for a job with a $10,000 salary increase, that's a huge return on investment. Networking, attending workshops, or even hiring a coach can open doors to opportunities you hadn't considered. Pro tip: prioritize personal development as part of your financial plan. Set aside a specific amount each year for courses, seminars, or books that will help you grow your career and income. 6. Neglecting health insurance. Health insurance may not seem like a thrilling topic, but here's the hard truth. Medical debt is one of the top causes of bankruptcy. If you're uninsured or underinsured in your 30s, a single unexpected illness or accident could wipe out your savings and put you in debt. For example, a simple broken leg can cost $7,500 or more without insurance. Can you afford that out of pocket? Probably not. If your employer offers health insurance, make sure you're enrolled to understand your coverage. If not, shop for a plan on the marketplace. Yes, it costs money up front, but it's far less expensive than facing a major medical emergency without insurance. Pro tip, check if your plan offers health savings accounts, HSAs, which let you save for medical expenses with tax advantages. 7. Failing to diversify investments. So you're investing, great. But if all your money is tied up in just one or two stocks or a single sector, you're taking on way too much risk. Diversifying your investments is one of the smartest things you can do to protect yourself. Imagine investing all your money in tech stocks. If the tech industry takes a nosedive, so does your portfolio. But if you have a diversified mix of stocks, bonds, real estate, and perhaps even some commodities, a downturn in one area won't cripple your entire portfolio. The key to long-term investing success is balance. Aim to diversify across different asset classes and industries. You'll thank yourself when the markets get volatile. 8. Not having a financial plan. Ever heard the phrase, failing to plan is planning to fail? This applies to your finances as well. Going through your 30s without a financial plan is like sailing without a map. You may eventually get somewhere, but it probably won't be where you want it to go. Your financial plan doesn't need to be complex, but it should include goals like buying a home, starting a business, saving for your children's education, or planning for retirement. Break these goals down into actionable steps and timelines. How much do you need to save? What's your budget? A plan gives you clarity and direction. Pro tip, revisit your plan regularly. Life changes, and so should your financial roadmap. 9. Underestimating the power of compound interest. We've all heard about compound interest, but do you truly understand how powerful it is? Albert Einstein called it the eighth wonder of the world for a reason. In your 30s, the longer you let your money grow, the more exponential your returns become. Let's look at an example. If you invest $10,000 at age 30 with a 7% return, by the time you're 60, that $10,000 will have grown to nearly $76,000. But if you wait until you're 40 to invest that same amount, you'll only have about $38,000 by age 60. Starting early makes a huge difference, and the best part is you don't need to be wealthy to take advantage of it. Start small, but start early, and let compound interest work its magic. 10. Not talking about money with your partner. Talking about money can be uncomfortable, but not talking about it is a recipe for disaster, especially in a long-term relationship. Financial disagreements are one of the leading causes of relationship strain and even divorce. Whether it's joint bank accounts, spending habits, or long-term goals, you need to be on the same page as your partner. Set aside time to have open, honest conversations about your finances. Discuss debt, savings, and future goals. This isn't just about avoiding fights, it's about building a life together based on shared values and dreams. Pro tip, consider meeting with a financial advisor as a couple. It can help you navigate tricky conversations and create a plan that works for both of you. And there you have it, the biggest financial mistakes to avoid in your 30s. Remember, this decade is all about building a strong financial foundation for the future. By avoiding these common pitfalls, you'll be well on your way to financial freedom. If you found this video helpful, give it a thumbs up and don't forget to subscribe for more tips on how to grow your wealth and secure your financial future. Let us know in the comments which of these mistakes surprised you the most, or which ones you're working to avoid. We'd love to hear from you.